Global markets react to President Donald Trump's tariffs, so what's ahead for the U.S. economy? I'm Veronica Dudo. Let's find out.
This is In America Today from the Ticker News Studios in New York City.
The U.S. economy is once again in sharp focus as global markets react to President Donald Trump's latest round of tariffs. Amid shifting trade dynamics, the Trump administration is also urging the Federal Reserve to cut interest rates following a disappointing private sector jobs report. With consumer earnings rising and markets adjusting, key questions remain about the broader economic outlook and the long-term impact of the new tariffs. Treasury Secretary Scott Bessent says inflation is easing and credits the administration's policies for a drop in gas, energy, and food prices.
A lot of it's already working its way through the system. So we've seen a substantial decrease in gasoline and energy prices. So that's down 20% year over year. We've seen the food prices go down, these notorious egg prices. Through the good work of President Trump and Secretary Rollins, egg prices have collapsed. So we're seeing more and more. And what we want to do is even that out across all sections of the economy. So inflation has been very tame. Consumer earnings were up 0.8% last month, which is a gigantic increase for 1 month. So real earnings minus low inflation is great for the American people, and that's what we're seeing.
I'm joined by Tally Leger, the Chief Market Strategist with the Wealth Consulting Group. Welcome to the show.
Thanks for having me, Veronica.
So first, let's begin with how are global markets responding to President Trump's most recent tariffs, and what does this mean for the U.S. economy?
So last time I looked, the global equity markets had surpassed their February peaks and have achieved new highs amidst the uncertainty. But I would point out that trade policy uncertainty specifically actually peaked around the week in, I think, April 11th, when the stock market started to bottom. So I think we're climbing out of that hole of uncertainty here, Veronica.
Now, again, this week, President Trump called on Federal Reserve Chairman Jerome Powell to lower interest rates after ADA reported weak jobs data. Today, the European Central Bank cut interest rates to 2%. Should the Fed have already cut rates, or do you think they might be moving in that direction in the future?
So we've been in the camp, and we remain there, that the Fed should continue its path of easing monetary policy. And look, to Scott's point, when we look at the progress we've been making on the inflation front, I think it does open the door to another volley of interest rate cuts from the Federal Reserve. And I think that would do a lot to support the economy and jobs here and spur the next leg higher in the equity markets.
So this is really taking over a lot of headlines as to the doom and gloom that we're seeing. But of course, when you crunch the numbers, it's telling a different story, a little bit of a rally. Can we just dig in a little bit and get your perspective on what's happening?
Yeah, well, to quote Captain Bligh from Mutiny on the Bounty, the beatings will continue until morale improves. And what I mean by that is the real pain trade here has been fighting the rally. The market continues to press higher despite lingering bearishness and negativity in the individual investor and consumer surveys. So I think one of the big lessons here is that hating the government is a bad investment strategy. It can harm your long-term returns. And we still have a long way to go until the bulls are stampeding, and we're not prepared to wave the checkered flag yet on this rally.
So, of course, we know there's the story of Wall Street and, of course, the story of Main Street. Now, we did hear Secretary Bessent mention that there's a significant rise in consumer earnings. Is this a sign of broader economic health or a short-term spike?
So, I mean, I would agree. Recently, we've actually seen a hook up or acceleration in real disposable personal income, excluding transfer payments. So, this is kind of real organic wage growth that we're seeing from the private sector. And it's up over 2%, meaning incomes have been outpacing inflation, which we talked about earlier, cooling there, by over 2%. So I think that's a really important first step in this conversation about a consumer that is in a pretty good position right here.
Could tariffs and interest rate changes clash in terms of economic impact, or do you think that they work in tandem?
So I have a non-consensus view on that score. In early February, I penned a piece questioning the inflationary impact of the tariffs, and my view has been and remains that I don't think the tariffs are as inflationary as most believe. And the starting point for that conversation is history, whether it was Trump 1.0 or the Smoot-Hawley Tariff Act of 1930. Over time, the tariffs proved to be disinflationary, uh, if not deflationary. And let's remember, a tariff is a tax hike. And to me, tax hikes are not inflationary. You know, whether it's incomes or profits here, when you raise taxes or costs like that, it is a break to activity. In this case, specifically trade. It lowers or dampens everybody's trade, and I think that's why it's nice to see markets are cheering Trump and Xi talking once again around a potential deal.
Which sectors of the economy are currently benefiting the most and the least from the Trump administration's economic policies?
So I think this actually goes against what many were suspecting. And again, we like to zig when others are zagging, and we cautioned investors against overstaying their welcome in defensive assets, including bonds and the non-cyclical sectors of the equity market. And that really means embracing the cyclicals. And to us, that has meant the industrials, the financial sector, technology, and consumer discretionary. And those trades, that positioning has been serving us well since late March, early April.
How is the second quarter shaping up?
So, I mean, look, again, I think that's another big surprise, and it's the resilience of the US economy. If you look at the Atlanta Fed's GDP Now tracking model, this is going to blow your mind, but it's almost 5% for the US economy. That's real GDP growth in the second quarter after, a slight dip owing to pulling forward imports because of those same tariff fears or concerns that we're discussing. So again, I think even if it's the weekly activity index that we look at, that's hanging in there around 2%, give or take. So I think that the fundamentals remain pretty stable, intact, and kind of underscores this theme or notion that we should be buying the dips.
What did we see with consumer sentiment in May 2025?
So it depends on what survey you look at, whether it's University of Michigan or the Conference Board. But either way, we did see some improvement. I think it was the University of Michigan that stabilized. It stopped going down. That's a change at the margin that was notable. When it comes to the Conference Board, it actually increased, driven by the expectations component. So again, I think that the real pain trade here has been the rally that has been leaving many behind. But markets, as we know, are real-time financial market variables. They anticipate coming improvement in sentiment and morale and the underlying economy. So if I had to guess, judging by the uptrend in consumer discretionary stocks and downtrend in oil prices and gas prices, I would suspect that more improvement in the surveys and the sentiment data are in tow.
And what should American consumers and small businesses be watching most closely in the coming weeks?
So I was looking at the sensitivity just this morning, in fact, of the smaller companies to stubbornly high interest rates. And this gets back to what we were discussing earlier, Veronica, about the need for the Federal Reserve to lower interest rates, because it's really the smaller companies that have the higher variable rate interest costs, and I think would asymmetrically benefit from a reduction in those same interest rates, thanks to or help from the very visible large hand of the Federal Reserve.
Tally Leger from the Wealth Consulting Group, thank you so much for your time today.
Thanks, Veronica.
This is Ticker. We'll be right back.